Good afternoon, everyone. I'm Moi from Stakeholder Management Market Operations. Thank you for taking the time to attend our Market Operations Industry Education Program on the topic, Harness the Power of Advanced Moving Averages and Momentum for Stock Markets. On the line, we have Shane Chu from LifeChain Sundaram Berhad, our moderator, and David Low, our speaker for today. Without further ado, I would like to hand it over to Shane to start the session. Thank you.
Thank you so much, Moy. So good afternoon, everybody. Our webinar title today is Harness the Power of Advanced Moving Averages and Momentum for the Stock Markets. All right. So as the title suggests, we are going to learn about how do we use advanced moving averages as well as momentum indicators and oscillators in the stock market. So we are very glad that invited David Low to conduct the session. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you are solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He holds the position of Managing Director at Top Infinity Sundaram Berhad, a proprietary trading firm that focuses on trading a range of financial markets, including global commodities, currencies, equity indices, and financial derivatives. He has 25 years of experience in Malaysia's listed derivative industry. Before starting his own consultancy, he held leadership positions in futures brokering divisions of major investment banks in Malaysia. He served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. So he's none other than Mr. David Low. David, how are you today?
Very, very good. And thank you, Shane, for that wonderful introduction.
All right, great to have you back with us for this session. So I will just stop sharing my slide and hand over the control to you, David.
Okay, welcome everybody to this session. We had last session on the 10th of July, right? If I'm not mistaken, 10th of July last week. And we're back today, and how the markets have changed over the last 4 to 5 weeks, right? So what we've learned last month and what we're going to learn today in the next 1 hour is going to make it even more important. I hope those of you who have joined us the last session has been able to use some of the techniques that we shared on that time, market structure and fractal structure, to take some profits and lock in some profits, okay? And now waiting to see when to get into the market again, okay? So let me quickly point to my slides. I hope you are all seeing it here. Shane, are we okay with the slides?
Yes, we are seeing your
Okay,
screen. All right.
fantastic. Okay, so let's not waste time. Let's jump into this very important topic. Harness the power of advanced moving averages and momentums. Okay, advanced moving averages, don't be afraid of that word advanced, okay? Actually, the calculation of the this particular technical indicator, of course, can be very advanced, but the application of it is actually very, very simple, okay? So what we're going to cover today, let's just move on. Okay, you've seen this, we've seen this, and this is what we're going to cover. Okay, quickly, the first part, we will talk a bit about technical analysis and the tools, just to get you, a very helicopter view of the tools and technical analysis. Then we'll move into moving averages, right? Different types of moving averages, how to use them, so 4 or 5 different techniques of using them, okay? How to use it to identify trends, and also talk about what are the advantages, and also this particular tool, moving averages, what are the shortcomings as well. We need to know that as well. Then we move into deep diving into momentum indicators, which is actually a natural progression from moving averages to moving momentum, and talk about oscillators. And in this part, you actually be learning about a leading indicator. How do you have a leading indicator to show you the direction of the market? Okay, so we'll learn that. And later we'll talk about integration. So we have this moving averages, we have momentum, we have the last session, the market structure and fractals. We are going to integrate integrate all of them and use it and apply all of them. And hopefully I can also show you some live charts towards the end of the, what do you call that, the session. Okay. So some of you who may have some favorite counters that you may have, you may request some readings there using what we have learned today as well. Okay. So that's the last part where we go into practical applications and case studies. All right, let's jump straight into this and talk about what is technical analysis. Won't spend too much time here. Basically, it's a study of price and volume of stocks or any assets. It can be indices, it can be commodities, any types of securities or assets, right? And the tool is basically using charts. Okay, charts is the main tool, and other statistical tools. Okay, and basically what we want to do with all these tools is try to forecast the potential price directions. Okay, so this is what technical analysis is, and what is the what do you call that, the assumptions in terms of technical analysis. Okay, the assumptions are this. Okay, three main assumptions in technical analysis. Number one is all information. Okay, and this is going to rub some of the fundamental guys a bit, right? Because technical, all those pure technical analysis guys they purely actually ignore fundamentals. Okay, but it actually can.
David, no voice.
Davis, you're on mute already. David?
Okay, am I good?
Yeah, you were on mute for half a minute just now.
Oh, half a minute. Okay, which slide was that?
You just rewind half a minute ago.
Okay, let me quickly rewind. Okay, sorry about that. Sometimes your mouse go and click something else. Okay, this is where we start. Okay, so what is technical analysis? Basic technical analysis is study of price and volume of stocks, indices, any asset class. It can be commodities. Okay, and the tools are charts and other statistical tools. Okay, and what's the purpose of TA? TA basically aims to forecast potential price trends. Okay, and technical analysis has three main assumptions. Okay, number one is all the market price action, the price action of the charts actually already has all the information is required. Okay, so any information impacting markets already reflected in the price. Okay, market action basically saying that market action discounts everything else. Okay, so this may rub a bit against some of those that study fundamentals, but I guess in terms of longer term looking at fundamentals, both and technical analysis as a timing tool, both can be used together. Okay, the second assumption is past behavior tends to repeat. Okay, and that's what we saw last week in the tools that we use, which was pattern recognition. Okay, because why do past behavior tends to repeat? Because markets are crowds of participants, human beings. Okay, reflecting human psychology and behavior, and human psychology and behavior tends to react similarly to identical market events. Okay, so that's the second premise of technical analysis. And lastly, the most important one is prices move in trends. Okay, so for any time frame, whether you're looking at the daily chart, you're looking at a weekly chart, or you're looking at an hourly chart, even a 15-minute chart if you're a day trader, right? Every single time frame there are trends. Okay, so these are the three basic assumptions of TA. Okay, so these are the tools. Okay, the first one we saw and we studied the last session, pattern recognition. Japanese candlesticks is also another type of pattern recognition. Okay, looking at different types of candlesticks. Resistance and supports one of the studies. Trend lines, moving averages, that's what we're going to do today, including momentum. Oscillators is also a type of momentum. Quantitative analysis, behavior analysis. These are the tools of technical analysis. Okay, so pattern recognition and moving averages are major usage. Okay, a lot of people use this. That's why we're covering it the last session and this session. All right, so let's talk about moving averages. Some of you are very familiar with you. Okay, those of you who have been using charts for a long time. Okay, moving averages have been with us for a long time. Okay, and one thing I must say, right? Some of you may have forgotten. Some of you may think that moving averages is outdated, okay? But I want to remind you that moving averages, more money has been invested and traded using this particular indicator throughout history and even until today, okay? Most of the automated trading systems, most of those what you call algo types of trading systems, all are actually based on moving averages, okay? Because I know that because I also design algo strategies, and moving averages is one of the most popular methods of using to design algos. Okay, so this is the earliest and most widely used tool, right? Professional money, all right? If you talk about institutional money managing timing, they use moving averages. Okay, and CNBC, Bloomberg, when they comment about long-term trends and all that, they also use moving averages. Later we will see, right? And the reason why it's so long-lived. It's outlived all the major type of very sophisticated, very complex kind of indicators. Is because it's very simple and it is very versatile. Okay, and this is a very important tool to have in your toolbox. Okay, it's a favorite among traders. Okay, and also trend-following investors. So if you're a long-term position holder, long-term investor, this is a very important indicator to use. Right? Okay, let's move on. Right. Why use moving averages? Okay, moving averages, the main thing it does is it smooths out the price data. Okay, price data tends to be sometimes choppy and has a lot of noise. Okay, so basically using a moving average, you smooth out the price data, and it's the purest form of trend following indicator. Okay, so it identifies trends very well because it doesn't take in the short-term fluctuations that could distort the market, the real underlying trend. Okay, so it smoothes out. It can also use moving averages as supports and resistance as well, right? Because often prices will tend to bounce off the moving averages, as the name implies, is the moving average is the average of those prices, right? So it tends to touch supports and touch resistance and bounce off there. Right? And basically the usage of moving averages among traders is to trigger signals for entry and exits. And we'll see all these techniques afterwards. Okay. And the moving averages basically is a trend following trading system. Okay. Remember this word, trend following. Okay. So it will underperform during markets which are choppy. Right? This is trend following. So sideways market, it will underperform. Okay. So this is something that you need to note. Right? So how to calculate the first most important and simple moving average is called this, of course, simple moving average, right? So we learn from this concept and we see how people try to make it more complex, right? So this is the most used moving average is the SMA, okay? Simple moving average, which takes, for example, if you take a 10-day moving average, basically you take 10 days of data, closing prices, okay? You calculate what's the average, okay? And then the next day you drop off the old one, you add in the new day, and then you calculate. Okay, so it's a moving average where the data points can continue to be calculated and moved forward. Okay, so of course the larger, smoother MA, that means if you're 10-day moving average, 20-day moving average, we will see you tend to be smoother. Okay, let's jump into it. You don't have to worry about the calculation because all the technical analysis platforms and trading, things like TradingView or even the brokers that give you your screens will have all these indicators, right? So this is a 10-day moving average, SMA, right? So you can see this chart is on the FBA KLCI, okay, Brazil Malaysia KLCI. This is 10-day, right? And if we go to a 20-day, okay, we move down to a 20-day, okay, sorry, a 50-day, right? You can see it's a bit smoother. It's a bit away from the prices, okay? And then if you add the 200-day, okay, the 200 is even smoother because it's taking 200 days of data, right? And if we've combined all of them, okay, so you see the 10, 50, and 200 on the same chart. You can see the 10-day is, of course, more sensitive because it hugs the prices, the bar charts closer. The 50-day tends to be smoother and the 200-day tends to be a lot smoother, right? So this is the famous 50-day and 200-day SMA, which you find it being reported in CNBC, when they talk about the trends going below the 200-day, that means it's going to a bearish stage, okay, long-term bear. And the 50-day SMA is used as like a midterm moving average to see the trends on the midterm. Okay, so this is a quick comparison between the three SMAs, the 10, 50, and the 200 on the KLCI. Okay, now people wanted to see how they can make a moving average better, right? So the other thing that people started to do this, what we call a weighted moving average, okay, WMA. Okay, so don't worry about the calculations. Okay, these are automatically calculated for you on your trading platform or the technical analysis platform. But basically what it does is it assigns more weightage to more recent price. Okay, we will see the picture of this. So the technical analysts believe that by doing this, the WMA, or the weighted moving average, will respond better to market movements. Okay, and let's see a picture of this. Okay, let's look at a picture of this. Okay, so you have the 50-day SMA, which is in red, and you have a 50-day WMA modded. So this is a modification. You try to modify this particular moving average. So you see that the average actually, the green line actually hugs some of the price patterns better. Okay, there's good and bad on that as well. Okay, later we'll talk about that. Okay, so this the WMA and SMA, there's the difference. Okay, all these are automatically calculated for you. Don't worry, you just pick what type of moving average you want and they will display for you. Okay, and now we come to another very popular modification, which is the exponential moving average. Okay, same purpose. They want to make it more responsive to market movements. Okay, and the EMA basically takes more recent data into more importance and assigning a multiplier to the more recent prices. Right? Let's see how it looks like. Okay, this is how it looks like. The blue is the 50-day exponential moving average, and 50-day SMA is in red. Okay, so you can see it's about, it's kind of like improve. Okay, it's got more signals, right? So they try to make it more responsive. But the problem with responsiveness is always a trade-off, okay? Because we're talking about SMA being a smoothing. All types of MAs are smoothing, okay? But when you make it more responsive, you will have more signals, okay? When you have more signals, it also have more false signals. So in the end, all those complicated, in the 1970s, that was where the bedrock of all the development into moving averages. There's actually even more complicated MAs than this, right? But those that really survive usage has been the SMA, the EMA, and also the WMA. Okay, so what you get in terms of getting more responsiveness is you get better or more faster signals. Okay, but there's a trade-off. Okay, you trade off between the smoothing effect of moving averages with early signals, and early signals and more signals, also more false signals. Okay, so this is something that you want to bear in mind. Okay, that is why until today, the SMA is still the favorite. The simple moving average is still the favorite. Okay, of course you can use WMA and EMA, right? We will see more modifications of it afterwards by seeing how we can apply all these three types of moving averages. Okay, so what are the popular moving average periods? Okay, what to choose? 10-day, 20-day, 50, 60, 200. There's so many, 14, 15, 12, 20, 25, 15, so many. Which one to use? Okay, but these are the popular ones that you see here. The 10-day moving averages basically traditionally used as a short-term indicator for traders, right? And this is if you're trading a 2-week period. If you feel that the market or this particular stock there's something happening in the next 2 weeks, then you look at the 10-day moving average, right? And if you're trading a monthly time period, then the 20-day moving average is probably more ideal, or something close to 20 days. And the 50-day moving average is basically used to chart or measure the intermediate trend, right? And this is, as we say, always used in combination with the 200, right? Because the 200 is where most people will look at that and see the dividing line between a long-term bull or a long-term bear markets. So if prices are below the 200, then it is in a long-term bull, long-term bear, and it's above the 200, MA is on a long-term bull, right? So that's how they see it. And you also have the 60-day, which is very close to the 50 days. And if you use the 60 days, then it's approximate about 3 months type of trend, okay? 3 months to 1 quarter. right? So you can try to modify, but I'll show you some suggestions of the popular ones that is used, okay, that has been studied and be used. But basically, you can use the what do you call that? These 10, 20, 50. If you're using for example 12, then you're looking somewhere along the region of the 10 days. Okay, so this is the guide for you of the popular MA periods. Okay, let's talk about the first technique of using an MA. Okay, the first technique is the price crossover. Okay, what's a price crossover? Basically, looking at your price chart and see where is it. Is it above the MA? Okay, if it's above the MA, then it's bullish. Okay, if it's below the MA, then it's bearish. Okay, so and this has been a very, very good performer for longer term trends. Okay, so this single moving average price crossover performs very well to filter the trend. Okay, it may not be the best as a signal generator, but it tells you the trend. Okay, but of course there are a lot of whipsaws as well. Let's have a look at the SMA. Okay, so this is the SMA 10-day. Okay, so this is good for like a 2-week trend, right? You can see that this red line, okay, if the prices are above the red line, it's on a bullish mode. Okay, if your prices are hugging, and this is what we call a whipsaw, okay, hugging, okay, it's on the moving average, then it's on the sideways, okay, this sideways, okay, sideways, this. So you can see that the prices actually, move above and below this MA, okay. So the 10-day, because it's a 10-day is closer to the chart, so it tends to have more signal, of course, right, because it has less moving, right. So it has also got whipsaws, okay. So we'll see how we can improve on this afterwards, okay. But still, okay, in terms of longer term monthly chart, okay, what I'm showing here is the KLCI, okay, and this is the KLCI from 2004 until, this is a 20-year chart, right, and this is a 20-year chart of the closing prices, okay, and you have a 12-period moving average, and this has been studied a lot by a lot of the technical analysis, technical analysts, and they feel, okay, for a monthly trend, if you're holding a long-term trend, this 12-period SMA is very, very good for long-term trends. You can see right over here, after post 2009, there was this very long good trend on the Malaysian market, okay, and started to come down, and again a return up in 2012, very good run, okay, and then became bearish for over the next 3.5 to 4 years, and then we had a good run in end of 2016, and then of course over here after 2018 the market was down, okay, and went sideways right over here during the COVID period. Okay, of course there were very good sectorial plays in the COVID area, and now, okay, now what we're seeing in terms of the monthly chart is the KLCI is on a uptrend. So this is the 12-period moving average. If you're looking at a very long-term trend, okay, monthly charts, this is a very, very good SMA. Right, just note that in terms of the experience and in terms of the research in long-term monthly charts, the 12-period is very, very, very good. Okay, so let's look at some of the examples on the 12 SMA crossover monthly chart. Okay, this is on Gamuda. Okay, you can always display this on any other chart that you have. All right, so you can see, in terms of Gamuda. Okay, in terms of telecom as well, you can see the trends. Right, long-term trends from 2019 onwards. Telecom was on an uptrend until 2021, almost 2 years, and end of last year, it moved above the 12 SMA monthly. Right, so currently in the monthly mode, it is bullish. Right, so this is a very, very good in terms of a long-term view, a monthly 12 SMA. Okay, so any other examples? Okay, so now that's one technique, all right? So now we go into a more improved version. We call it the dual moving average crossover. So now we are playing with 2 moving averages instead of 1, okay? So you have, 1 second, okay. So you have what we call a shorter term MA with a longer term MA. So you combine 2, right? So the longer term MA, you use it as a trend filter, and the shorter term MA, you use it as a signal generator. Okay, so some popular combinations are 5 and 20 day, right? So the rules are very simple. If the short MA cross above the long MA, then you buy. okay, or remain bullish. And if the short MA goes below the long MA, then you either take profit or stay away. Don't go into the market, right? Okay, this how this chart looks like. This is on press metal. Okay, this is until July 30th. Okay, this is the orange one is the 5-day. Okay, and the green one is the 20-day. So when the orange line moves above the green line, okay, some examples here. If you can follow my cursor right over here, do you see the cross? Okay, where you have the cross is a crossover. Okay, you turn long, you will buy. Okay, and you hold your buy until it crosses below, and it crosses below right over here, crosses back up here again, so you can enter the market right over here when it crosses over. Okay, when it crosses down, okay, you lock in your profit, stay out of the market until it crosses up again. Okay, and in somewhere mid of July, there was a cross down. All right, right over here. You will stay out of the market, lock in profits and all that. Okay. Incidentally, of course, if your eyes already well trained, you can see a fractal here, right? Right over at this price, about 595 or 593. There would have been a profit-taking sell right over here. Okay, and that was last month's lesson, right? If you remember, okay, and you can actually combine those fractals with this crossover method as well, right, to take profit. Right, we go into another chart example. This is Bursa Malaysia, right? You can see the crossover right over here in towards the beginning of May, right? That's where the trend really started to move, right? And the crossover here showed the 5 over the 20 right over here. Okay, and we had one very nice run over here for this particular counter. Okay, so this is how you use MA crossover. 520 is just one of the possible combinations, right? And one of the most followed is, of course, the 50 and 200 day. Okay, this is where all the news channels internationally talks about it. So there's what we call a death cross. The death cross is where the market, if prices cross the 50 cross below the 200, then it goes into a long-term bearish market. And if it crosses up what we call a golden cross, then it's on the start of a long-term bull. Okay, and as you can see, the golden cross actually happened somewhere in August, September of last year for this particular stock, Bursa Malaysia. Right, you can see right over here. This is the golden cross, right? So those of you who had used this 50 to 100-day cross, then of course you'll be there, going into the market around the 640 level or 650 level. All right, so this is the 50 to 200-day, always as seen on TV. Okay, very popular on TV. Okay, and this is for the KLCI as well. You could see that the golden cross actually happened in September, okay, of last year. That's when this 50-day crossed over the 200-day. Of course, there are the cross down as well, right? Here, we don't see on the left side, but of course, the chart stayed below, the 50 stayed below the 200 for quite some time as well for the KLCI. Right, so now in terms of the golden cross, we are on the bullish phase, basically implying that it's on the long-term bull. Right, so this is the 50 and 200-day dual MA crossover. Okay, this is one technique. Now we're going to look at even more complicated. Now we're looking at triple moving average. Okay, so why do people try to make it more complicated? Basically trying to improve the performance. Okay, now the problem of moving averages is you have a problem when it goes to a sideways trend. Okay, so the triple moving average basically try to solve the problem. Okay, it combines a short, medium, and long period MA. Okay, so one of the popular ones are 4918. I encourage you to go and explore this 4918 triple MA, which is very good. These are the rules. Okay, you don't have to remember them. Just understand. You will have notes of this as well. So it's 4 is above 18, and 9 is above 18 is uptrend. That means all the moving averages are above each other. Okay, uptrend. If one of them 4 below 18 and 9 above 18, then it's sideways. Okay, if 4 above 18, 9 below. Okay, don't worry about this confusing thing. One look at the chart, you understand. Okay, sideways. And if everything is below, then of course it's on the downtrend. And there's one very specific usage here. If you are basically on the long side, that means you've been holding a long position on equities. And if the 4 goes below 9, it's time to take profit. okay, an early signal to take profit, okay. And for those of you, of course, who can short the market, maybe you trade the FKLI, okay. If the 4 moves above the 9, it's time to take profit on your short positions, okay. So let's see how it works. Okay, it's not very complicated. You go into your MA setting, you put 4, 9, and 18, as you can see on the top left, right over here. This is the KLCI. Okay, so in terms of this range, okay, so what it tries to do is when the short-term moving average, the short-term one is the orange colored, you can see, right? The middle one, the 9 is the purple, and the long one is the green, right? So once the short-term one, the 4 closest below the what do you call that, the purple, okay, you want to be out of position already, right? Because it's saying that it's going into a sideways. So that's the advantage of using this triple moving averages. It can tell you when the market is going into a sideways market, okay? So in this range market as well, you can see right over here as the 4 moving averages goes below the purple, which is the 9. Okay, it's basically signaling that if you are on a long position, you should be locking in your profits already, right? And it's going to a sideways, and then actually after that it went down. All right, and when everything is up right over here, okay, the what do you call that? The orange is above the purple, and the purple is above the green, then it's on a uptrend. Okay, so that's how you use it. And once the orange one crosses over the purple, then it's time to take profit. Okay, that's how you use it. It's very sophisticated, and actually the 4, 9, 18 is an excellent triple moving average crossover. Okay, we still have versions after this, but this is one thing that you want to explore as well. Okay, any other example? Okay, this one example for CME Group. Until July 31st of this year, you could see right over here, its signal, all lines are above each other, right? This where it goes up, and it also shows you where you should be taking profit. Okay, so there are the trends, there's the profit taking zone and the sideways zone. You don't commit yourself. When it goes above, then you go in. Okay, so this is how you see, and this is on the CMB Group. Okay, next, this is on Tenaga National, another example of the 4, 9, 18 moving average, triple moving average crossover. And you can see that it works really very well as well. All right, right over here, it signals a buy, go long, and then here it signals a take profit. Okay, here sideways you stay out. Okay, sideways to bearish you stay out. Here, well, you took some profit, not very much, okay, but still profitable. And of course, if you wrote it right over here, you have many instances you're able to hold, and many instances you can lock in some profits and then go in again and lock in some profits as well. Right, so this until July 31st, you could see right over here as well. It signals what they call that, basically to take profit right over here. Right, so a lot of times if you use this particular tool, the moving average, and you use the tool we did last month, okay, a lot of you, okay, or a lot of the clients could have actually locked in some very nice profits before, you know, the 5th of August phenomena, right? So of course, you know, everybody went through that 5th of August, such a crazy Monday, right? So you will have seen it. The signs are there, right? It's whether you want to follow it or not. Okay, so you would have the tools to be able to make a good decision. Right, now let's move from triple moving average now going towards the momentum. Okay, and one of the most famous moving average kind of indicator is what we call the MACD, MACD, right? And this was designed by Gerald Apple. Gerald Apple is designed this specifically for the stock market. Of course, it can be used for other types of commodities, but it works well, works best with stock markets, right? And basically, MACD, a lot of you are perhaps more familiar already, okay, but we have to cover it, okay, because it's one of the very important tools as well, right? And there's another usage actually for the MACD, which we will talk about afterwards, okay? Basically, it's designed basically 3 moving average. The EMA actually is the EMA, 12 and 26 difference, and then they plot a 9, okay? They plot a 9 to do the signal. Okay, so it is usually displayed in a histogram, so it's make it easy for you to see the crossover, right? If it's green, if it cross above the 0, then it's a trigger on the long side, on the buy side, and if it's a red, then it's on the short side or it's on the bearish side. Okay, so this is the MACD as displayed. You will see it Okay, it is a very, very popular indicator as well. And the MACD works excellently for longer term charts. Okay, it may not perform well in terms of very noisy markets, especially if you're using it to try to trade a 15 minutes. Okay, so the mistake is trying to use a tool in the wrong time frame. Okay, so MACD is very good for longer term charts. So if you're looking at weekly charts and monthly charts, this is an excellent indicator. Okay, so don't use it wrongly. Some people try to use this on 15-minute charts and it just basically doesn't work because there's just too much noise. Okay, so bear in mind. Okay, so this is a MACD crossover on daily. Okay, so I'm showing you the crossovers. The green dotted vertical lines is where you go on the long side. Okay, if the red one, you stay on the short side. Okay, and as you can see right over here, these are the signals where you go in. It's pretty handy, right? You can see on the sell side, okay, if you're an equity trader, of course, you avoid this market, and then you enter it right over here again when it cross over on the upside. Okay, I'm basically showing you all the crossovers using the vertical lines. So you will have caught good trends as well, right? You maybe have chopped up a few times right over here, but you wouldn't have many bad losses, okay? If you keep your stops tight, and here you avoid, and here you go in again, you have nice phases in terms of the market, okay? And you got out here as well, pretty handy. And in terms of this chart, this chart is until July 30th, okay? Your MACD also say that you should be out the market, right? So you shouldn't be experiencing that phenomena on August the 5th. You should be out already, even on the MACD. And this is on the daily chart. Okay, let's look at it. The MACD crossover for Tenaga, right? So you can see right over here. Okay, there is, of course, in the sideways market, it's going to underperform. Okay, but it won't like hurt too much. Okay, it's just that you don't have really nice signals right over here. But when it trends very well. Right, this is just example for your study. You can use it when you look at the notes later. All right, so what are the disadvantages? Okay, I've told you a lot of advantages. Okay, it works well in trending markets. Okay, this work excellent on trending markets. Okay, sideways market poorly. Okay, but there are ways to avoid that, as in like the 4918 triple moving average, and we will see later the next two ways on how to avoid this sideways market. Okay, so technically it's a laggard. Okay, because it's on average, it's a laggard. Okay, so it performs very well and to confirm patterns, but it's not predictive. So later you want to find what is something that's predictive, what is leading. Okay, so this is laggard. Okay, later we'll see some leading. Okay, and the problem with this MA is so many configurations are which one to use. Okay, what I've shown you just now are the popular ones. You can of course experiment with it. Okay, but what you see you can use already, plug and play. Okay, but if you want to do some minor adjustments or some fine tuning, you can go ahead, right? But this so many different types of configurations can actually be a bit confusing for the uninitiated. Okay, so bear in mind this particular tool. Okay, it's got its very, very good points. It also has its weaknesses. Right, so now let's see how we can address some of these weaknesses. Okay, now I'm going to show you another moving average. Okay, and this is a indicator developed by Bill Williams. Okay, the original guy that developed the fractals indicator. Okay, he also has this alligator. He calls this the alligator. Okay, this triple moving average. Okay, don't get into the technicalities. Okay, this is a 13 period, 8 period. Okay, and also a 5 period. Okay, so this is a 5, 8, and 13. Okay, but it's displaced. Okay, so this is now another modification. It's displaced to the right. Okay, it's move 8 bars in the future here, move 5 bars for the 8 MA, and move 3 bars, move forward. Okay, so this is another, but this is a very, very useful. Okay, so alligator, you can get it from all the popular technical analysis platforms. Okay, just plot, don't have to calculate, just plot it. Okay, and this is how it looks like. These 3 lines, the green, the red, and the blue. Okay, that's how it's traditionally displayed. Okay, so the rules are very simple. Okay, Don't worry about all these words right over here in the technical jargon, okay? So basically how you see a trend is this. If the lines are moving, opening up, okay, it's like an alligator opening its mouth, very hungry, okay? That means it's basically moving in a very strong trend. And when it comes back up, okay, it's like an alligator closing its mouth, okay? Makan sudah kenyang. Then it will close its mouth, okay, and then it's going to consolidation, okay? And every time it opens its mouth, again, it's hungry and is in the trend. Okay, so a widening lines are the trend growing strength. Okay, and narrowing lines are trend losing strength. Okay, that's how you read it. Okay, you can take note of the reading later, but let's see how we can use this. Okay, now using the alligator, we want to use it like a filter, okay? Filter the trends, okay? So last week we talked about the fractal signals, okay? Now one way to filter the fractal signals is you only take the fractal signals when it's above the tree lines of the alligator. That means it's on the uptrend, okay? So you only buy when it's in a confirmed uptrend, okay? So all these signals you see, these are the buy signals from the fractals, okay? This is familiar. You've seen that last month already. All these are buying above the tree lines, okay? That means buying into a confirmed trend, okay? This is a Tenaga National chart. Okay, you're buying into a confirmed chart. So we use the alligator as a filter, okay, as a trend filter. So is this uptrend and downtrend? If prices are trading above the alligator, then it's on the uptrend, okay? If it's trading within the alligator, it's sideways, you don't want to be there, okay? Of course, it's below, then it's on a bearish mode, you don't want to be there, right? You must already have locked in your profits, right? You take buy signals only if prices are above the tree lines. Next example. Okay, here, this is JCY. Okay, you take the, this until July 9. You take the signals, the buy signals, these are fractal signals. You take the buy signals, okay, only is above the tree lines, okay? Yeah, this signal is triggered above the tree lines, you buy, okay? And of course, here, this is a take profit level. This was July 9th. Next example. Okay, another study of this. This is a Bursa Malaysia daily chart. Okay, this is until July 9th as well. So you take the buy signals above the tree lines. Okay, you take only when it triggers above the tree line. Okay, so basically using the alligator as a filter, right? So it's a very convenient way of reading the trend. If you see the prices are moving above the alligator, you can confidently announce that this is on the uptrend. If it's sitting right here, you can see right the consolidation here, right? Between February 19th and beginning of May, it went to a sideways. So it's sitting on the alligator. So the alligator's mouth is closed. So it's a $T, you know, the alligator is sleeping. So it's on a sideways trend. If it's hugging the triple line, it's on a sideways trend. And when it's above and it triggers a fractal buy, then you are on a uptrend. Okay, so it's very easy to use, right? Although the calculation is a bit more complicated, but the usage of it is the application is actually very, very simple. Okay, now we've had the alligator. Now let's talk about momentum. Okay, we're talking about now going to an indicator that can be a leading indicator. Okay, so let's talk about race car cornering and market turns. Okay, so if you are driving a race car along a corner, right? Again, these are the techniques of driving. If you want to learn how to take a corner in a race, this is how you do it. But the important thing here is this: when you are going into the corner, you will take your foot off the accelerator, right? You will not be pressing on the accelerator. Okay, you of course be changing down your gear and you be braking, right? Before you make a turn, you have to brake. Okay, so how does that apply into the markets? Okay, very simple. I'll show you this next slide. Okay, price. Okay, if you want to understand the physics of market, price is the last thing to change in the markets. Okay, remember this, price changes last. Okay, and this is how it works, right? The trader will make a decision, okay, and his trading decision will have an increase in volume, okay, and then it will start to have a speed in momentum, okay. After that, it gains momentum, and then only price change. So price is the last thing to change, okay. Momentum will change first. So if you understand how to read momentum, you will see the market taking a break, breaking already, already lifting off its foot from the accelerator, okay, changing gears and stepping on the brakes already. And all these are indicated in the momentum before the direction changes, okay, before he turns the corner. All of that will have happened before the price change, okay? So this is a very important thing to note, that price trend changes direction after momentum. It must come to momentum, must come to a near stop. Just like this pendulum right over here. It moves up to the top, it has to stop before it moves back down. The same thing, accelerates, it goes up, and when it wants to turn direction, it has to stop and then change direction. Okay, so understand this in terms of momentum. Okay, and how do we apply momentum? We want to see momentum in terms of this principle called convergence and divergence. Okay, and which momentum indicator to use? Okay, use back Bill Williams. Okay, Bill Williams has got really nice indicators. Okay, I've been using his indicators for almost like 30 years already. All right, very, very good. Okay, so you use this awesome oscillator. Okay, go into your platform and bring up this Bill Williams awesome oscillator, or called AO. Okay, AO basically is this definition. Don't have to worry about it. Okay, for those who don't have AO, then you can modify your MACD to do a 534.5. Just change your settings to 534.5. Okay, this is the definition, but we don't want to go into the technicalities. You can display it. Okay, and then this is how it looks like. Okay, this is the AO. Okay, it looks like the MACD, right? Yeah, just now we said that your MACD, you can actually modify it to be the 534.5. You just change your, okay, so this is a, as it moves up, okay, as it crosses down, then it's red. As it crosses up, then it's green. Okay, if it goes below the line, okay, it crosses down, right? So this is up and down, up and down. This is the histogram. So why and how can we use this, right? We want to look at momentum. Of course, this momentum peak, okay, if you observe my cursor right over here, this momentum peak is higher than this momentum peaks over here. What does it mean? It means that in this phase of the market, the momentum is stronger. Okay, of course, as it goes down, momentum will go up, will go down. Okay, and as you can see right over here, later we'll see. Okay, momentum will lead. Okay, let's move on. You know how to display already. Use the AO. Okay, let's talk about momentum divergences. Momentum divergences and convergence these are what we call leading indicators. Okay, it will basically signal to you before the actual event happens. Okay, and this is a very important principle. Okay, so what are divergences? Divergences happen when the price moves in the opposite direction to the momentum indicator. Okay, what does that mean? Okay, so right over here, we will see, okay, but before I describe this, what is a divergence? When you have a divergence, it's basically forecasting a potential change in direction. Okay, that means the market is breaking already, it's changing gears already. Okay, it's potential. Okay, now you need to, of course, use other confirmations. Okay, but it's basically telling you, flagging to you, hey, look out, there's a corner coming, right? So a bullish divergence means what? A bullish divergence means the prices are going down, and what you see right over on the right side here is a bullish divergence. You have prices actually coming down, but the momentum is actually moving upwards. The momentum is not weakening, right? So here is basically telling you, ringing the alarm bells. Okay, this trend, yeah, although its prices are coming down, but potentially there will be a change in direction. Okay, so this is called bullish divergence. And the bearish divergence, what's the bearish divergence? Basically strengthening prices. That means prices moving up and then weakening momentum, which we will see a lot of what they call that examples afterwards, right? So this is bullish divergence and bearish divergence. Okay, this is on the stock maxis. Okay, this is in 2021. You can see right over here, you have prices coming down, but you have momentum going up. So basically, it's telling you to get ready to go long. Okay, now you don't go long. The first time you see a divergence, you don't go in and buy. Okay, basically you need to have confirmations. Use your fractal or you use a moving average, but this one basically is already telling you to get ready, right? And then right over here, in September of the same year, you can see as MACD prices move higher. Okay, then this high here is followed actually by a weaker momentum. This is what we call bearish divergence. The first example is bullish divergence. That means markets are going to go up. Bearish divergence means that the market is potentially going down. Okay, so these the two types of divergences you want to look out for. And let's look at some examples. Okay, this is Genting Malaysia, August of November 2021. Okay, you can see prices are coming down. You have the lows coming down, but you can see the momentum going up. So there's divergence. Okay, so basically potentially telling you that the market is going to recover. Okay, and this is a very important tool to use in terms of finding tops and bottoms as well. Next example, this Top Glove, August, November of 2020. You could see that Top Glove prices made new highs, but the momentum did not make new highs. Okay, basically this top, okay, is lower. Okay, and those of you who like Elliott wave, basically this is what we call the third wave against the fifth wave. Okay, so the fifth wave have the less momentum, the third wave have the most momentum. Okay, for those who like Elliott wave. So the bearish divergence is here, then you will look for any sell signals to take profit or to get out the market. Okay, so those are the examples, and now we are going to combine everything we've learned in the last two sessions. Okay, now let's look at CIMB. This is 2020 to 2021. Okay, what you have here on this chart is you have momentum, bullish divergence. Okay, you can see prices over here, and then you get ready to look for a buy signal, right? It goes above the alligator. Okay, it goes into a bullish. When prices move above the alligator, is bullish. And then right over here, you have a fractal breakout, which basically there's a structure breakout. That means this is your price buy signal triggered right over here. Okay, so combining three things: momentum, okay, the moving average, which is the alligator, and also the fractal structure. Okay, let's give you another example. Okay, this is my EG from June to November of 2021, right? You can see prices coming down, but you have a bullish divergence. You have momentum actually going up, okay? And then, okay, sorry, the alligator here not displayed, okay? But the alligator is above the alligator. You take a buy signal when it breaks this one. Okay, so you're looking for a buy signal here. You're looking for entry into the market. Okay, now how does this apply to the current market situation? So if the markets are continuing to go and consolidate, okay, you want to see whether they are bullish divergences or not. Okay, if prices are coming down on any particular counter you're watching or any particular market that you're watching and it's coming down, but momentum is going up, then you get ready. It's basically sounding to you, it's time now to look for an opportunity to get back into the market. All right, so let's have a look. This is Genting Malaysia from October to July. Okay, July 31st of just a couple of weeks back, 2 weeks back. You can see already, but this bearish divergence, okay, basically the market is telling you, hey, you know, the market is getting ready to correct. Okay, so it's time to probably lock some profits. Okay, when you see a signal, watch for a signal to take profit. This is called bearish divergence, where prices are going up to new highs, but the momentum is not. Okay, let's look at another example, and let's see whether we have time to go into some live charts afterwards. Okay, Axiata Group is November to July 30th as well. As you can see right over here, at the end of May, right? Sorry, at the mid of May, you could see the bearish divergences. Okay, prices are going up, right? But the momentum is going down. Okay, and right over here, you actually have a fractal sell. You should have locked in your profit if you have bought this particular counter up. Okay, of course, here there is you have taken some profits here as well. But if you re-enter the market and you see a bearish divergence, it's basically saying that the market is going to go in a longer term or a longer consolidation or correction. Okay, so these are what we call the leading indicator. Let's see whether we have another example. Oh, okay. I'm going to go into live example. Okay, so bear with me. Let me switch my screen to a live chart and give you some examples. So meanwhile, get your questions ready. Okay, and we can take some questions. What do you call that? As I show you some of these charts. Okay, let me share charts. So take a few minutes to going some charts right here. Okay, I hope you see. Shane, are we good with the charts? Can you see?
Yes, we are seeing your trading view.
Okay, yeah, this is my trading view. All right. So let me quickly just go into the triple moving average again, right? So this is a chart that we saw just now, right? So this is a great way to look at some of this one technique that's very, very good. Combine it with your fractals, okay? Just to display for you, right? So we go back to what we saw just now. Okay, so what we have displayed over here is fractals, alligator, and also the what do you call that? AO. Okay, so for Axiata Group, just now we saw already, right? You see prices going up. Okay, here going up to a new high, but momentum is going down. So this is a bearish divergence. Okay, so let's look at some other stocks. I have a random list of stocks over here. Let's see how this looks like. I think Malaysia, you have seen this divergence as well, right? Just notice this divergence right over here. Right, market's going up. Okay, but momentum new high, but momentum is going down. Okay, let me draw something for you so that it's easy to see, right? Okay, momentum going down, prices moving up. Okay, basically ringing bells to say, hey, get ready to take some profits because I'm going to come down, right? So momentum always shows you first. Okay, let's see what just to get some. I'll just click on any chart, okay, but you can look at your whatever favorite charts of yours, okay, unless you have special requests, okay, yeah, right over here. So it has prices that okay, actually flattish, and then you have momentum coming down. Okay, so basically signaling to you that the market's going to turn. Okay, let's take perhaps a more see what other stocks you can get. Okay, YTL Power if you like. Okay, let's display that and see how it looks like. Okay, so we have again divergence over here. Okay, divergences. Okay, new price highs. Okay, and then the market turns. Okay, so display these three things: the alligator, the fractals, and also the momentum. Okay, to get what do you call that? A read on that. Okay, I'm going to my slides are done, so I'm going to pass it back to Shane for some questions.
Yep,
Shane, back
so
to
we are
you
now
while I stay on some charts. Okay.
yes, we are now opening the floor for Q&A. If you have any question to ask our speaker David, please write your question in the chat. I see William asked a question, but I don't know which chart he referred to. Maybe William, can you type the name of the counter? Okay, so Robert would like to ask you, what do you mean by fractals?
Fractals is lesson number 1, August, so July 10th. Okay, fractals is basically a 5-bar definition. Is a 5 bars with the middle bar the highest. Okay, that's called up fractal. Okay, and then down fractal is a 5-bar formation with the lowest bar in the middle. Right. So anytime we have these fractals are very important swing points in a particular chart. Okay, it usually defines the important highs and important lows, including the supports and resistance. Okay, so if you have the chance to revise back, okay, get from your colleague the previous session notes, then you would have actually some materials to look back on. Okay, we covered the fractals very comprehensively in the previous chart. Okay, so look back and that and go back to that. So those are the swing points in the chart. So if you can see on the chart right over here, the green points are all the fractals, okay, and the red points are all the down fractals. So any price break above the fractals highs are what we call the bullish signals, okay, buy signals. Okay, and we want to get into the market, let's say, for example, right over here, when it breaks the fractal, I mean, trades above the fractal and above the tree lines. I hope that's helped Robert a bit.
All right, thank you so much, David. So William would like to ask you, according to Genting Malaysia charts, is it forming a bullish divergence now? So that is in reference to the last 2 pages of your slide.
Okay, so let's look at a live chart of Genting Malaysia right over here. Okay. Yeah, your eyes are very good, right? Okay. So now what you see right over here, right? You can see now, this is momentum, right? Yeah, momentum is moving up, and then prices are still, of course, down. You have lows right over here. Yes, this is a bullish divergence. Okay, so what this particular chart is basically signaling to you is this market or this particular counter is poised for a recovery, right? So now what we want to look for is, okay, here you have a fractal right over here. It's not triggered above yet. Okay, so if it triggered above, it's bullish, and if prices trade below this, above this three lines, this alligator. So if it trades around here and above the alligator, then it's a good opportunity to re-enter this market, right? So that's what basically it says. I hope that helps, William. Yes, very sharp eye you got. This is a bullish divergence. This is a bearish divergence right over here, and this is a bullish divergence. Good eye.
Thanks, David. Vivian would like to ask, could you please share your view on IOI property and SDG? Thanks.
Okay, let's look and see what the chart says. Not David Lowe say, it's the charts. IOI properties. Okay, let's look at the charts. Okay, what do you have right over here? Okay, now, of course, you know that if you were holding this particular counter, you would should have locked in some profits right over here. And there's a fractals, just to revise. Okay, there's a fractal cell here. Okay, you should have taken some profits right over here. Okay, around the 238, 239, you should have locked in some profits. Okay, it's even gone below here already, so you should have locked in your profits. Okay, so now the market action is basically, of course, most counters experience the same thing after the August 5th. Okay, it's basically on a correction. Okay, do we see any, what do you call that, bullish divergence? Okay, so you're looking for opportunities to get back into the market. Okay, so is the timing correct? Okay, we see some slight the bullish divergence, okay, because right over here, the 2 points, okay, so you have markets coming down and you have a divergence over here. Okay, so if we continue to see the momentum moving up again, of course, look for fractals over here. Okay, the next couple of days, whether you can see an up fractal over here. Let's say, for example, it forms an up fractal over here. Okay, then this is, of course, speculative. You need it to show first before you actually go in. Let's say, for example, if this high, okay, and this high is around the 214, and you have prices trading below 214 for the next couple of days, right? And then it goes up and break 214, and then that will be a setup. Okay, you have all the conditions met, you have a bullish divergence, you have a fractal breakout, and you have also the market prices moving above the triple moving average. So you have the conditions which is right to get back into the market on the long side. I hope that's helped, Vivian, on IOI. What is the other counter?
SDG.
SDG. Okay. Plantation's a bit tricky. Okay, of course, it's trying to get away from plantation. All right, this chart you can see, if I just basically put it, has been in long consolidation, right? So whether this particular chart will break out from this very, very important sideways line. This is normally closest below this line, this trend line, right over here, right? So as in a lot of commodity-based, palm oil-based counters, they currently is in a consolidation, right? It tends to close around this point. Okay, so basically it's in a quite defined sideways trend. You see, it's so long. Okay, so if I were to trade this particular counter, I would trade it as a sideways corrective counter in terms of every time it comes out to around 416, 415, a bit long, then it goes up and meets resistance at about the 460 levels, then it comes down. And it's been doing that for like, how long has this been, right? You can see that it's been quite some time, right? It's been a couple of months, it's been trading sideways, okay? But what is the opportunity with this particular counter? If this particular counter has some developments and you see prices shoot up above and close above, like the close above, not only shoot up, close above around the 460 to 470, then I think you have something to look at. Okay, at this current moment is on the sideways, so it's a kind of not so trendy, right? Yeah, not so trendy. So if I'm a range trader, this would be a nice trade. Every time it comes down to 416, I'll buy, and goes up to 460. This particular 40 cents range, I will be trading it as a sideways trend. Okay, so this basically what the chart says is in a sideways trend for SDG. Back to you, Shane.
Thank you
And
so
thank
much,
you for the question.
David.
Yeah.
Hafiz would like to ask this question. May I know, do you have any recommended books on technical analysis which we can learn more about divergence?
Okay. Divergence convergence is a very classic technical analysis. So any books by Martin Pring, and those technical analysis for financial markets, all that will cover because it's a very classic pattern. Okay. So any technical analysis book, even those that I recommended the previous session, you can use them. Okay. So any good technical analysis book, especially Martin Pring. Martin Pring is one of the encyclopedias or Bibles for technical analysis, right?
All right,
Back to you,
thanks,
Shane.
David. The next question is, are the techniques that you share applicable to the overseas market?
Oh, okay, very interesting. Let's look at some overseas markets. Okay, let's look at let's look at the S&P then. Okay, S&P. Okay, S&P, of course, something you want to look at as well as a reference, the US markets, okay, what the US markets are doing, right? So what do you see right over here, right? You can even read the divergence right over here, So basically saying that this particular trend up in terms of March to current, okay, you can see the divergence right over here as well, okay. What this means for the allocation, and I like elevate very much, is this is what we call the fifth wave, okay. So the fifth wave is the last wave of a bullish market, okay, and after that it will go into a consolidation, which currently the S&P is showing that it's going into a consolidation mode, okay. So as far as the S&P is concerned, it's not out of the woods. Okay, it's not out of the woods yet. Okay, you don't see any bullish convergence right over here, right? So this is a one way to see it, right? So S&P is more indicative. You want to see, let's say, for example, you want to see the NASDAQ tech stock. Let's see whether I have the NASDAQ right over here. I have the mini NASDAQ, but it's indicative as well. So you can see again, okay, the NASDAQ is a little bit more bullish in terms of bearish divergence. It doesn't have, okay. So basically now you can consider the NASDAQ is going to a fourth wave correction. So there's still potential for the technology stocks to rise above this high in terms of the market reading, in terms of elite wave. But currently it's still on the downside, okay. So you can see fractal breakout here. Actually, if you were trading NASDAQ or NASDAQ related stocks, right here is where you should have locked in some of the profits. Okay, right over here, that is in July the 17th, you should have locked in some profits because the indication is there. And then it went into the alligator. That means it's going to consolidate. And right over here, when it broke, this one is on a selling mode. Right. So yes, you can use it for overseas markets to monitor all the other indices or other markets that you are following. Back to you, Shane.
All right, thanks, David. So it looks like we have overrun the session by 7 minutes. So that's all the time we have for question and answer session today with David. Thank you so much, David, for sharing with us how do you use advanced moving average as well as momentum indicators and oscillators in the stock market. Thank you, everybody. So ladies and gentlemen, you just listened to the Managing Director of Top Infinity, who is Mr. David Loh. Thank you so much, David.
Thank you, Shane. Thank you, everybody.
All
Happy
right.
trading.
Bye, everybody. Hope to see you in our next session.
Thank you.